We've got a whole bunch of central bank meetings from all over the world, and these are coming at a very critical time. The Swiss National Bank did cut by 25 basis points as expected and now are only one step away from zero. We've got the Bank of England, the Swedes, even the takeaway from the Fed yesterday, it wasn't the dots. There's an ugly update from Australia that is definitely going to impact the Reserve Bank there. The Swiss started everything 1 year ago, and it wasn't supposed to be an every meeting thing or an every meeting with a 50 thrown in on one of them. Like everyone else, the Swiss National Bank foresaw a gentle glide, a rate cut here or there spaced out over a couple years. But the simple truth of the matter is the economy wasn't what they all thought it was. But that's not what they said, of course. All of the world's central bankers keep saying it's strong and resilient, soft landing, just a little uncertainty. But it's not what they say which matters, it's what they've done and are just as likely to keep doing. Some of these central banks, as I pointed out recently, have done a lot already. Those who haven't, like England and Australia and the Fed in America, they are in reality moving a lot closer to the doers than they want you to realize. For the Federal Reserve, the main takeaway yesterday wasn't the uncertainty that piled up in their dots, it was the downgrades applied to their SEP. The same as what I talked about yesterday, sweeping Wall Street. The Fed and all the world's central banks can see the weakening coming. And while they're going to blame tariffs for it, that can't have been the case since this race to the bottom began an entire year ago. In other words, that race didn't start with trade wars. It's been well underway for a period of time, and the finish line isn't even in sight yet. Remember, rate cuts are not stimulus, they're a warning. They're telling us that even central bankers can see the weakness too. And central bankers began to see this weakness in the world economy as far back as last March. It was the Swiss National Bank in March of 2024 that shocked the world by cutting rates at a time when everybody was absolutely certain higher for longer, inflation was the greatest risk. And what the Swiss said was, yeah, inflation is the greatest risk, but going in the other direction. And they blamed correctly global economic circumstances for their plight. The reason they started cutting rates a year ago was because the global economy was turning in the wrong direction at precisely the time everybody thought it was reigniting in inflation and about to confirm and reach its soft landing. So the rate cuts from the Swiss were a warning that other central bankers were going to end up seeing the same thing, which is what we all saw develop over the last half of last year into early this year. Not trade wars, not tariffs, global fundamentals left over, the forgot how to grow economy. But even when the Swiss got started, it was more out of an abundance of caution. They were not expecting to cut at every single meeting, which is exactly what did happen. And now after cutting by 25 basis points today, they brought their benchmark repo rate down from 0.5 percentage point to 1/4. They're only one step away now from zero. And while the Swiss National Bank statement and officials have said they want to be done here, they know very well that there's a good chance they won't be done. In fact, the statement they released today said, with today's rate adjustment, the SNB is ensuring that monetary conditions remain appropriate given the low inflationary pressure and the heightened downside risk to inflation. The SNB will continue to monitor the situation closely and adjust its monetary policy if necessary, interest rate policy, to ensure that inflation remains within the range consistent with price stability over the medium term. The economic outlook for Switzerland has become considerably more uncertain. That's the language everyone is using. That's the term everyone's using now. And against the backdrop of increased trade and geopolitical uncertainties worldwide, developments abroad continue to represent the main risk, which is exactly what they said a year ago. So here we are, the Swiss are a year later, and what has changed? Really, nothing has changed, and that's not a good thing because it means that the rate cuts that they've been implementing so far haven't really helped. Not that rate cuts in the single central bank jurisdiction like Switzerland are going to impact the global economy. Like I said, the rate cuts, especially from Switzerland, were a warning. They were a warning that what has happened was going to happen. And so there's still a warning, still the fact that they're cutting rates even further. And appearing on CNBC, the head of the Swiss National Bank, Martin Schlegel, said,
so in monetary policy, if you see a need to act, you have to act early and decisively. And this is what the Swiss National Bank does. Because waiting does not add value. If you wait, then you have to react even more in the future.
Which is exactly the point, that he's almost like he's talking to the Fed and the other holdouts. And it's exactly what I've been saying all along. Once these central banks start down the road to rate cuts, They can't stop because rate cuts don't help. Once they see the economic fundamentals turn in the wrong direction, they're forced into cutting more and more. And so what the Swiss National Bank head here, Mr. Schlegel, is saying is that when we see weakness, we have to respond to it immediately. We can't wait around because we know not that the rate cuts are going to help. We have no other choice. The weakness continues regardless. And so central banks end up chasing the economy down further, which is exactly what we've seen over the last 6 months. As you can see, there are global consequences to this forget how to grow economy, forgetting even more and maybe even remembering how to recession. And that's what we're going to go over Monday, March 24th at noon. Webinar for Eurodollar University. There's a link in the description to sign up. What's happening? What's the next trend in the global economy emerging or global financial system too? And maybe what we can do about it. There's a lot of stuff to go over here, a lot more than people realize. So join me next Monday, March 24th at noon. Link in the description to sign up for our webinar. I hope to see you all there. So this isn't really about trade wars. They're making it about trade wars now, but it wasn't about trade wars. The weakness in the global economy, the exchange rate, the Swiss franc, the sudden appreciation of the franc was a flight to safety as the world realized in 2024 it was not heading toward this soft landing. Instead, the exchange rate got stronger because the market sensed the forgot how to grow economy, which showed up in 2022 and only got worse in 2023, was going to forget even more growth and growth potential in 2024. Exactly what we're seeing and exactly why central bankers are chasing it with this race to the bottom. And as far as the Swiss are concerned, maybe they need to watch what's happening in their watch industry. Watch the watches, because the watch industry is signaling all sorts of distress, and not just distress, but the same loss of global momentum that we've been seeing here in the United States as well as around the rest of the world. As Bloomberg reported today, Swiss watch exports downward trajectory resumed in February after a 1-month respite, with all main markets seeing a decline. Shipments from Switzerland's third biggest exporting industry fell 8.2% overall, hampered by slow demand in China, the Federation of Swiss Watch Industry said on Thursday. In total, 102,000 fewer watches were exported. And here's another thing. Even the U.S. market, which had previously held up, faltered in February with shipments down 6.7%. And that's consistent with everything we're seeing as well. U.S. consumer spending, which had been the story holding up maybe the entire global economy in the face of all these headwinds. That's the Fed kept saying, what everybody kept saying about the soft landing. Consumers are holding up. And then the data that we've gotten for this year so far, retail sales and others, income statistics, now the Swiss watchmaker saying even the U.S. appears to be buckling too. That's not tariffs. That's the fundamentals of the forgot how to grow economy, which central banks have been reacting to, whether they've said so or not. Another one where we see loss of momentum and serious downturn, Australia. Now, it was only 1 month for the payroll report, the latest payroll report, but it's a concerning sign that even the Aussie economy, which is historically one of the best economies that are out there, one of the most dependable in its operation, even in 2008, 2009, as the world suffered through the Great Not Recession, the Australian economy weathered it pretty well and did even better during the 2010 silent depression. So for the Australian economy to show more and more signs of buckling, that's not a good one for either Australia or the rest of the world. What was reported today? Australian employment surprisingly dropped in February, sending the currency and government bond yields lower as traders boosted bets on further interest rate cuts this year. Employment declined by 52.8 thousand, led by full-time roles. It's something we've seen all over the world, including the United States, compared with the forecast for a 30,000 increase, according to government data that showed yesterday. The jobless rate held at 4.1%, reflecting a fall in participation, another problem we keep coming across in all of these economies as well. Now Australia is starting to exhibit the same symptoms of forgot how to hire and forgot how to work that we see in the US, Canada, as well as in Europe. And remember, the Reserve Bank of Australia, which cut by 25 basis points last month, was the last major central bank to do rate cuts. And I said at the time last month that the global economy appeared to be catching up with Australia. But you could see the signs coming that the forgot how to grow economy was heading right for Australia. And while the jobless rate is low there, it's not a good sign that it's ticking up and that the jobs market may be in the process of reversing. So While the Reserve Bank of Australia, like every central bank last year, said they're going to go carefully and cautious, there's increasing pressure and increasing realization that maybe even the Reserve Bank of Australia might have to quicken its pace of rate cuts too. Not to stimulate the economy, that's the intent, that's what they say, but as a reflection that weakness in even Australia is starting to become too much to ignore. Over in England, the Bank of England, which is another laggard like the Federal Reserve, and like the Fed, no surprise, right now they don't know what to make of tariffs and consumer prices either. They're basically taking this meeting off, like the Fed, to see how the world develops in the wake of any tariffs and trade restrictions that are implemented. So the Bank of England today was on hold. Again, it's all about uncertainty, not that the economy steadied or the outlook has improved, simply because they don't know what to do in the face of the prospect that consumer price numbers are going to increase in the short run. Basically, exactly what Jay Powell said yesterday. The MPC, the Monetary Policy Committee, noted business survey indicators in the UK generally continue to suggest weakness in growth, and particularly in employment intentions, while domestic price and wage pressures remain somewhat elevated. It said risks around the near-term outlook for activity in a number of advanced economies, including the UK, remain to the downside. It's what all these rate cuts are about, reflecting that downside. In addition, the MPC pointed out that since its February meeting, global trade policy uncertainty has intensified, citing U.S. tariffs, while other geopolitical uncertainties have also increased. They're always going to blame tariffs. This was a rapidly evolving situation, which it would monitor closely and assess further in the May policy round, according to the Monetary Policy Committee. If you remember the last Bank of England meeting where they did vote to cut rates, the controversy surrounding it, where Catherine Mann, who had been one of the most hawkish central bankers in the entire world, suddenly switched from voting against all the rate cuts up to that point and instead voting for a 50 basis point rate cut last month, joining one of the other doves on the committee, Swati Dhingra. And instead, here we go, fast forward 1 month into March, the Bank of England gets together. Now Catherine Mann, who went from ultra hawk to ultra dove, now says, I don't want to do anything. She voted for holding policy rates here in this meeting. And even Dhingra, who has always been advocating for at least 50 basis point rate cuts, she shifted too and said maybe we should only cut by 25. So you can see what's happening here, even in the Bank of England. While they see economic conditions continue to deteriorate, they're worried, like the Federal Reserve, that consumer price estimates that are going to increase, assuming that tariffs do get applied and trade restrictions do end up happening, as those consumer prices go up, they're not sure what to make of them, so they're sitting here paralyzed. That's what's happening with these central banks like the Fed and the Bank of England. They're paralyzed about what could potentially happen on the consumer price side because they don't understand what inflation really is. If they did, like Jay Powell claims, then they would do what Jay Powell actually said yesterday, which is let the short run considerations happen, the price increases take place, and then the economy weakens tremendously on the other side. Because this isn't inflationary, these tariffs will be disinflationary, but not in a good way. They'll harm an economic situation that is already in bad shape to begin with, thus the central bank race to the bottom, which began an entire year before. You look at the labor market data just in the UK, and you can see why they had a dovish tilt up until more recently. The last payroll, I'm really going back to last July, payroll growth across the UK has been basically zero since July of 2024. And the unemployment rate has moved up and has been holding steady at 4.4%. So the labor market is already weak to begin with, and they can continue to see signs and surveys and everything else telling them that businesses are going to continue cutting back on workers. At the very least, they're going to stop hiring, which means unemployment is going to continue to rise. The economic situation in England, the UK, is going to get even worse. So rate cuts to chase the weakness that's up ahead once they get past all of this tariff uncertainty stuff. In Sweden, the Swedish Riksbank said they're done cutting. In fact, they held interest rates steady at this meeting and basically forecast doing nothing for the next couple years. The Riksbank's decision to hold its key rate at 2.25%, announced on Thursday, was predicted by all but one economist surveyed by Bloomberg. The central bank sees no change to borrowing costs throughout its forecast period that runs into early 2028, like they'll be able to do that, disproving some economists who had projected it could signal higher rates because Sweden has experienced a bout of consumer prices in the same way that everybody's worried about tariffs. Sweden has experienced food prices that have surged more recently. So that increase in the CPI, of course, economists, any increase in the CPI, any acceleration is treated as inflationary pressure. So many economists started to believe that maybe the Bank of Sweden, the Riksbank, is going to actually have to raise rates this year. But instead, while Theden, who's the head of the Riksbank, and his colleagues have sought to push the largest Nordic economy from its 3-year bout of near stagnation, their efforts, some of the most dovish policies, biggest rate cuts among the developed nations, have so far failed to bring about a decisive turnaround. This is no surprise because, as I keep saying, rate cuts don't work. They're only an acknowledgement that central bankers see the weakness too. And that's exactly the same case in Sweden. So as the Swedish economy, which continues to worsen too, unemployment continues to rise, will the Riksbank be able to hold, like it expects today, at 2.25%? As one economist said to Bloomberg, the Riksbank decision to update guidance showing a 3-year hold at 2.25% suggests policymakers have a balanced view of the risks to their outlook. Again, they're seeing upside risk to consumer prices, but not really acting on it. Our baseline is for a hold through this year, but we wouldn't rule out another rate cut if the revival in activity proves to be even more tepid than the meager short-run forecast, especially if a tariff war kicks off next month. In other words, the Riksbank says they're done, but we all know that they're not. Last year, they said the same thing. Last year, when they started cutting rates in May, they expected they're going to cut 3 times in 2024, bringing their benchmark rate from 4% down to maybe 3.25%. Instead, they cut by a lot. They went from 4% all the way down to 2.75 by the end of November, and we're at 2.50 right at the start of January. So it's not what central bankers say, it's what they end up doing or what they end up being forced to do. And that will apply to the Federal Reserve as well. Now, the Federal Reserve did announce a further taper to QT, and I wrote a whole lot more about this, what it means and what it really means, what everybody takes it to mean and what it really means at Eurodollar University's deep dive analysis. But like the Bank of England, the Federal Reserve like the Bank of England like the Federal Reserve, they're all taking they're basically paralyzed by the potential impact on consumer prices based on tariffs and trade restrictions. However, they can see the weakness coming, which means that the takeaway from the Fed meeting yesterday wasn't the dots, where the dots showed more policymakers increasing as this uncertainty over tariffs really hits home with their lack of understanding on inflation. So the dots rose relative to where they were in December, which was higher than they were in September, seemingly hawkish, but that was really about uncertainty rather than a pickup in the real economy. What really came out of yesterday was in the SEP, as I said in the introduction, or the Summary of Economic Projections. The SEP showed that even the Fed is expecting weaker economic growth in 2025. They lowered their GDP forecast, the central tendency range, by 0.3 percentage point, both the top and bottom, the upper bound and the lower bound. Now they're thinking maybe 1.5% in 2025 to 1.9%. So what they're basically saying is we're getting down toward recession territory, which is the same as what we saw from the downgrades all across Wall Street that I went over in yesterday's video. So even the Fed, once you look past the uncertainty and their paralysis over tariffs and consumer prices and the effect of tariffs on consumer prices, even the Fed is moving one step closer to the race to the bottom too. And that's exactly what the markets reacted to yesterday, with bond yields dropping all over again. The Fed is moving closer to the race to the bottom along with everyone else. It's not what central bankers say or what they say today. It's what they do and what they're likely to do in the near future. At the end of the day, rate cuts are not stimulus. They're a warning. And they've been warning you for an entire year all around the world. While everybody fixates on the Fed and its supposedly hawkish stance, central banks have been acting. They've been saying one thing, strong and resilient, just a little bit of uncertainty, but what they're actually doing is quite different. The race to the bottom is not just on, it's been in full swing for quite some time. And as further we go into 2025, forget tariffs, the further we go into 2025, even before then, the more central banks are joining the race to the bottom, and the more that those who are in it, maybe lagging behind, are getting closer and closer to more fully participating in it. And while some central bankers are saying they want to pause here, it's not because the economy is picking up, it's only because they don't know what to do about tariffs and the short-run impact on CPIs. Well, Once the tariffs happen, assuming they do, they make the bad situation worse, which takes care of the whole thing about CPIs, which is what the bond markets are reacting to, which means more race to the bottom up ahead, lower and lower interest rates. Officials deep down know it too, but they'll never say so. But again, like I keep saying, it's not what they say, it's what they do. And what they do in the form of a race to the bottom and rate cuts essentially confirms that what they've said has been completely untrue. One central bank that we've left off here, the People's Bank of China, because in China, the People's Bank of China doesn't really matter. The banking sector does, and this is what the banking sector is up to in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Join me Monday, March 24th for our webinar, link in the description. And until next time, take care.